Hey there, everyone. Happy Friday. It's May the 3rd, and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a cloudy Redmond, Washington. Today, Friday, we're going to do a special all-mailbag edition of our show. Can't thank you guys enough for sending in some really thoughtful questions about technical analysis, about market dynamics, about investor psychology. A lot of really interesting questions. We're going to get through as many as we can here on this episode. Keep them coming, by the way. Email is always best, thefinalbar@stockcharts.com. Send us your questions as they come up. We'll do hopefully answer your question in our next mailbag show. With that in mind, let's get to question number one. Dave, the Nasdaq Bullish Percent Index, $BPNDX, has crossed over 30. Would you consider this a good risk-reward time to enter a position? And you sent in a link, and thanks again for doing that, by the way. You sent in a link to the chart that you were asking about. As a reminder, when you're sending in questions below the chart here on Sharp Charts, there's this little chain link, and if you click on that, this is the link you need to send me. So when you send in your question, include that link, then I can bring up a live version of the chart that you're talking about. On our ACP platform, there's a similar sort of icon in the lower left corner of your screen. Make sure you send me that link. It just makes it easier to see what you're talking about when we're looking at charts. So here's your chart of the Nasdaq 100 $NDX. We have PPO at the top. We have a candle chart. We're looking at the last year or so. We got some trend lines that you drew on there. And actually, before we get to it, I will tell you really interesting use of trend lines. You call these fan lines, I think I would describe these as, where you basically have an initial trend line that breaks. Then you have a new trend line that's formed and then validated with a couple takes. You create that with the second trend line. Then you have a third one. We didn't complete this one, probably extend it up to there, and that's the third one that's broken. And usually breaking three fan lines like that is a pretty negative sign. There is a whole set of things called speed lines, Gann fans, which are, have specific proportions that they use to define the slope of the lines, but looks like you're using just kind of a basic version of what's called fan lines, and I think that's a brilliant way of sort of illustrating or validating the declining trend or the declining slope of the trend of the Nasdaq from the October low really to where we topped out here in March, and now what we've seen. Then you have RSI showing the declining momentum. One of my guests earlier this week, Gina Martin Adams, highlighted that on the chart of the S&P, which was 100% agreed. There's the bullish percent index, and then you have relative strength at the bottom. A decent chart here, so I like how you're combining a number of different things all together, so thumbs up on that. So you're asking in particular about this series here, which is the Nasdaq 100 Bullish Percent Index. I have my own version of the chart, which I often show, and I would agree with you. What's happened is this indicator has gone below 30%. The bullish percent index on the S&P 500, which I often refer to, is kind of up around the 50% level. It's kind of not down here just yet. And the basic way I use this indicator is what I think you're asking about, which is when we go above 70% and then come back below it. You actually have 75%. I actually use 70, but whatever works for you. I'm fine with it too. But a break below 70 for me is pretty negative. We saw that soon after the July peak last year. When we get down to 30%, ideally we get a little bit below there and then pop higher. That's a buy signal at the October low. Here we had a couple sell signals using the level you were defining here in December, really, and then in February. I use 70%, which is a little bit lower. So for me, the sell signal really didn't happen here until February. Basically told you that the momentum was big time declining, or the breadth was declining using the bullish percent index. So now, getting to your question, yes, using this indicator, it does generate a buy signal, right? And for me, the indicator getting below 30% and then back above is your buy signal. So we actually got that a couple days ago, about a week ago. I think the challenge for this is that buy signal actually going to work? And what's interesting is you saw here in January the most recent sell signal, whether you define it as back here at the end of December or here in February. For me, it's when it breaks below 70% here in mid-February. The market moved higher another month or two before we eventually got to the top, and I'm wondering if a similar sort of condition is happening here. The breadth is so negative on these growth stocks. Traditionally, it would make you think that we're probably getting a tradable bounce. I think it's a tradable bounce, which we are getting, but is it the bottom? Is it an October 23 kind of low? The rest of my toolkit says not yet. And so for me, I would agree with you. Yes, that is a buy signal using this particular indicator. when I combine it with the mosaic of indicators we've talked about on the show, would I say that this is a good time to be buying the Nasdaq? Probably not, based on the other things that we've talked about. By the way, here's what my chart looks like. And again, not that my way's right, but just as this is how I've used the indicator. I usually show the Nasdaq Bullish Percent Index in the top segment and then the S&P at the bottom. Don't ask me why I do that. I've forgotten. It seemed like a good idea a long time ago. Here's what I was talking about, where the indicator went well above 70%, then finally gave a sell signal for me right about there. And now we're at this point where we have indeed gotten a buy signal here. So again, for the record, yes, I would agree that is a buy signal. For me, that's, I've never trade off of one particular indicator, but thinking of the overall mosaic, I would say the fact that the breadth, generally speaking, is still negative. The fact that a lot of individual growth names look quite vulnerable, even some bearish candle patterns this week that we highlighted with things like NVIDIA, Netflix, Apple, concern me a little bit more. Great question, though, and thanks for sharing your chart. Question number 2, sentiment indicator. I love this one. Sentiment indicators appear to just follow the market trend. What value does it really add? And you had a series of, or a longer form question that I sort of boiled down into that particular question, but I appreciate you asking about sentiment indicators. Something I've heard before, right? I'm bringing up, maybe the name exposure index, because this is one we've referred to on the show a little more recently. Not too long ago, we had Ryan Redfern, who's the president of NAME, which is the organization that actually conducts this survey of their members. Had him on the show. We've had him on before to talk about this indicator and what it is. And I think what you're observing, and I don't know which indicator you were thinking of in particular, but looking at this, look at the trend. This is a weekly chart of the S&P going back for the last 7 years. Look at the trend in the name exposure index, and I would agree, they look very, very similar, right? In general, when the trend is lower, you're seeing sentiment go down. When the trend is higher, when the market bounces, you're seeing trend go higher. Now, what's interesting is I've seen very similar comments about RSI. As a matter of fact, one of my former analysts at a large investment firm never used RSI because he says, I think the price alone tells me what I need to know about momentum. Why do I need RSI to tell me what the price is doing? And I'll tell you what I told him, right? I mean, number one, use whatever you think is going to help you pick stocks well. That's where you need to start. But in terms of determining whether something deserves to be in your toolkit, I think with indicators like momentum indicators like RSI, what you have to remember is it's kind of like taking a Z-score for the price data. And if you don't know statistics, Z-score is basically where you normalize the price movements, right? The challenge with this is I'm looking at the larger trend when I'm looking at the chart of the S&P. But if I really want to think about the momentum within some of these moves, by standardizing that, and the RSI is basically doing kind of what a Z-score does, which is, sort of normalizing it and just looking at where we're at relative to extreme movements and highlighting when a particular move is heavier or weaker than normal. That's the value. And so when something like RSI becomes overbought or oversold, it's not some magical formula. It's literally just telling you when the days or whatever is used to construct this indicator, when they're getting to an extreme level, way bigger than normal, to the upside or to the downside, it tells you that we've sort of gone to one of those 2-3 standard deviation kind of moves, and we'll probably get some mean reversion as a result. So something like the name exposure index, I think one of the great benefits is that it's bound, right? It rarely, if ever, gets below zero. It occasionally, I think, has done, but very, very rarely. It rarely gets above 100%, and so it generally goes between 0 and 100%. The S&P is not so bound, right? The S&P could go to 10,000 or 100,000 eventually. It could go down to 1,000 again. Not likely, but possible. So having an indicator like this, which is more normalized, can be beneficial. The other thing about sentiment is what you have to remember is when the market goes up, money managers, institutional investors, and certainly individual investors tend to get more and more bullish. And the higher the market goes, the more bullish we get. And at some point, the anecdotal last buyer has bought, and there's no more buying power to push us higher because everyone that's really excited about buying into things have done so. And as a result, the price starts to come down a little bit. And Tom DeMark, who I worked with earlier in my career, used to say, market doesn't top because of an influx of sellers. It's an exhaustion of buyers. And so looking at extremes in sentiment basically tells you when the buyers are exhausted and when a top may be had. So I think that's one of the benefits of sentiment indicators. For me, to be clear, it goes in order of importance. Price, most important. Breadth, secondary to that. Sentiment, very much tertiary. That's the third that I would look at after price and breadth. But I think it is an important part of the toolkit because it's great, basically a window into sentiment. By the way, Sentiment, look at the, we don't have it on stock charts, but the CFTC, the Commodity Futures Trading Commission reports, look at the positioning data on dollar, and you'll find it's pretty compelling as to where we're at right now in this cycle. Sentiment indicator that has value. Next question. When you look to the left, quote unquote, on the chart, how far actually makes sense? And this was a very long question that someone sent in. I really appreciate you talking about all the different macro influences. And basically, when I think of history for the markets, how far back is it relevant to what I'm looking at today? What I'm going to do to answer your question, by the way, is go to our historical chart gallery. And the way that you get this is a fantastic resource on Stockcharts. Go to the Charts and Tools button in the upper left, and then down the right column, you're going to find something that says Historical Chart Gallery. This is one of those pieces. If I did a special of like 5 things people don't use on stock charts that they definitely should, this would certainly be one of those 5, hands down. And if you go to important market indexes, go down to, we can go here, right? The Dow back to 1900. Just the fact that you can look at the trend in equities for over 120 years is pretty amazing, right? And just think about all of these different market cycles. So, you were talking about a lot of the conditions now and thinking about how does that relate to, 2007, which was the last, real significant major market peak in the mid-2000s. How does this relate to the late 90s, that, the AI-fueled mania that we've seen recently? How does that relate to the tech bubble? Even looking at the Nifty 50 era, the 70s and some of the major tops that we had there. I think there's a lot to be gained by looking to the left on the chart. So the short answer to your question is, I think, generally speaking, if you're looking at a daily chart, something like the S&P 500, I would say the further to the left you look, the less and less relevant it is to the current data, right? Because, and that's just a generalization, right? If I'm drawing a trend line, if I'm looking at support and resistance levels, because the markets have a memory, but not a picture-perfect memory, right? They don't have that photographic memory and remember particular price levels at particular points. Some people do, but it's very rare. As investors, we are more attuned to what recently happened. There's actually a thing called a recency bias, where we're actually really focused on recent data and tend to project beyond what just happened. But I would say looking to the left, the more recent things happen, the more meaningful they are, which means, a couple years from now, the 50-50 level and where it hit resistance in February of 2024, in February of 2027, I'd say that's probably not a very meaningful level. Right now, I would say it's pretty important, right? So there's diminishing returns as you go forward. But having said that, I would say there's great value in thinking about how a current market compares to previous parts in market history. And if you think we are in a period of high inflation, which we are, and you think we're in an interest rate hike cycle, which we have been, and where the Fed is sort of keeping rates stable, and then at some point is going to be lowering them. Looking back at previous parts in market history where those similar things have happened, I think makes a ton of sense. One of the things that has come up with a number of my guests, and again with Gina Martin Adams this week, we talked about inflation being high, rates being high. Very few of us have experienced that. You have to go back to like the 70s and 80s for the last time that sort of combination of things happened. So look back to the sort of go-go years of the 1960s, the stagnation in the 1970s, the raging bull market of the early 80s, and think about those periods and how they might relate to the conditions you're observing now. By the way, a book to read thinking about those periods. The go-go years is great about the 1960s. Bull, and I forget the author and the subtitle. I'm so sorry for that. But there's a book called Bull with an exclamation point. And it basically talks about 1980 to 2005-ish. Kind of period, talking about that bull market phase. I learned a lot thinking about that period and how it evolved. I'd point you there for sure. Next question. You recently said the Home Depot chart, HD, was constructive if it held 330, but price is below the 50-day moving average and it's underperforming the SPY. Could you clarify this? Really interesting question here. And I'm thinking about, this is a couple weeks ago, I think, when I made this particular comment. And, I think what I was, actually, no, I think it was last week when I got this question. I was talking about here and saying if 330 held, it would still be a constructive chart. And your comment is, but hold on a second, it's already gotten pretty negative. And I wouldn't disagree with you. I think it's probably, a shorthand is, what you do when you bring up a chart at the beginning is think about where we're at relative to where we've been. So the reality is we have now broken through the 50-day moving average. The reality is the momentum has declined from being overbought in the third week in March to now being, on our side below 50 and now breaking below 40. So as we get lower and lower, in my head, I'm thinking, where may there be a floor for something like Home Depot? So the two things, maybe three things that come to mind. Number one would be moving average support. So finding support at a 200-day moving average. I'm quite certain that's one of the things I was thinking about when I mentioned that, because we hold the 200-day, that's more of a long-term trend gauge. As long as we hold the 200-day on a chart like this, things aren't horrible. The second would be momentum, and it's less about overbought, oversold levels, but the range in that. And I would say the fact that the RSI is down in this range at all is usually pretty negative, right? Look back in like September of last year when we broke down below an RSI of 40. That wasn't the bottom. That was the beginning of a big downtrend. And I think the fact that the RSI did not hold at 40 is probably one of the more negative things I would observe on this chart. Then finally, I might use Fibonacci retracements to look at this move from October to March and see if there's some key levels to pay attention to between the two. And that might have been part of the story as well. But I think what I was thinking of was the 200-day moving average, and it's more of like a line in the sand, right? Where might you expect support? Where could you anticipate a low now that we've broken all the levels that we already have? But I would agree with the assessment that you sort of implied in your question. My general sense of this is a negative chart as opposed to a positive chart because we broke moving average support, because we made a new swing low. We're now making lower lows and lower highs. The RSI is very much in the bearish range. Those are all negative signs. I'm just trying to look for something that could tell me where do we get a low. The 200-day is a reasonable place to maybe expect that. There's a lot more I would need to see on that chart to get really excited personally as a holding in a portfolio I was running. Next question. I'm curious about the CMT program. Do you feel like your CMT training really benefited you and enhanced your skills? I really appreciate you asking about the CMT. It's often on, my name will see the CMT after. Most of my guests, to be honest with you, are CMT charter holders. It stands for Chartered Market Technician. And that is a series of 3 exams. You have to study a ton, read a ton, look at hundreds, if not thousands of charts, and then take some fairly rigorous exams about technical analysis, market history, market dynamics, portfolio management, quantitative methods, all those sorts of things mixed into one. And it's really meant to identify someone who has achieved a professional qualification in technical analysis. It really was started for people that analyze stocks as technical analysts on Wall Street, and now has become anyone really using them in a professional setting. It's a good process. So, I would say a couple things. Number one, if you do hope to have some sort of professional role as a technical analyst, I would say it is 100% vital. If you are working in some financial institution and want to be a better risk manager, a better assessor of risk versus reward, a better market timer, a better analyzer of particular stocks and ETFs, I would say it's incredibly valuable. If you're an individual, that's where I think you have to think about it versus other things. I would say the good news if you're an individual is a place like Stockcharts has amazing free resources, right? So if you go to Stockcharts and click on Chart School, this is still free for everyone, right? And when I was studying for the CMT, I actually used the Chart School on Stockcharts to supplement the readings and look at more examples and just get a different way of how it was mentioned. And John Murphy, whose writings are really the foundation of the CMT program, his work is really what inspired most of the Chart School that you would see here. But it is fairly unstructured, right? You have to be a self-starter. You have to be very motivated to really learn the breadth of technical analysis from a website like Chart School. It's really not designed for that. So one of the great benefits of the CMT is it gives you structure. It forces you to learn about everything. So I learned about Elliott wave and point and figure and candlestick charting and relative performance and all of these things. And then I think the real benefit is when I look at a chart like Home Depot and I try to analyze it, the process that I went through in something like the CMT exams really helps me come up with a really good checklist that I now have in my head that I go through systematically to analyze the chart and make an investment decision. I found before going through the CMT program, it was a little more sporadic, a little less polished, and a little less rigorous, and certainly way less systematic. That was one of the big things I learned. And besides that, it's a great network of technical analysts around the world. So I'd encourage you to check it out. cmtassociation.org is their website if you want to learn more about the CMT. Finally, can you go over your market top checklist and let us know where we stand? Yeah, I did a webcast on this back in March, if I remember right. We talked about the market top checklist. I'd actually done that webcast a year or two before. It was actually like January, February of 2022, if I remember right. And we talked about the conditions and how they were evolving. And I think one of those things is anytime I think it's a really good time to do a market top checklist, usually means it ends up being right around the top. So I did it in March. Ended up being a really good time to do it. So this is the market top checklist that I shared on the webcast. I'll show it to you briefly just so you can see where we're at. You can make your own assessment, but I think of it in 3 buckets, right? You have early warning signs, those initial signs that things are getting ugly. Bearish momentum divergences, we saw a ton of those back in February and March. Breadth not confirming new highs. Of course, all of the advanced decline lines went below their 50-day moving averages, less than 50% of stocks above their 50-day. I think those were all checked there. Structural changes, underperformance of previous leadership is the way I would probably edit this going forward. And I would say all the tech names rolling over, check mark there. Improvement in defensive sectors. This is a really good one. This is one of the charts that I actually added to the Mindful Investor Live chart list earlier this year because I thought it was a really interesting way to think about rotation. So here's the relative performance of utilities. Here's the relative performance of consumer staples. Here's the relative performance of real estate. Now, real estate still pretty underwhelming on a relative basis. Consumer staples actually had a pretty positive April on a relative basis. That's the best month it's had in probably a year plus. But look at the performance in utilities from the late February to now early May, incredibly strong. And utilities is one of those interesting sectors to watch because I found people own utilities, particularly institutions, when they just don't want to own anything else. We've broken down through S&P 50/50. Dow theory, I think, has given a sell signal, and indicators like the weekly MACD have all generated a sell signal. So, since we did that webcast, I would say all 7 of those, in my opinion, have been checked off. That's one of the reasons why I would say, looking at the chart of the S&P, it seems weaker rather than stronger. But again, we'll see how things evolve here as we wrap earnings season, digest this week's Fed meeting, and look forward from there. Folks, that's it for our special all mailbag edition. Thanks so much for sending in your thoughtful questions. Keep them coming. The final bar at stockcharts.com. We could also always use a couple more. By the way, tomorrow, May 4th. So may the 4th be with you. Have a great weekend. We'll see you on Monday.